Google just told Meta, one of its biggest customers, that it cannot give them more AI. Not because Meta didn't want to pay, not because the technology doesn't exist, because Google simply ran out of capacity. Welcome back to AI Assets, your daily edge on AI investments. This story broke in the Financial Times this weekend, and it is one of the most revealing signals about the true state of AI infrastructure in 2026. Google, the company spending hundreds of billions of dollars on AI, could not meet Meta's demand for Gemini computing power. Meta's internal AI projects were delayed. Employees were told to use AI more efficiently. In Silicon Valley language, that means slow down because the pipes are full. Let's break down exactly what happened, what it means for your portfolio, and what smart investors are watching right now. What actually happened? In March of this year, Google informed Meta that it could not fulfill the level of Gemini AI computing capacity that Meta had requested to purchase. This is not a small client. Meta is one of the most AI-hungry companies on the planet. They are building AI into every product: Instagram, WhatsApp, Facebook, Ray-Ban glasses, and their internal developer tools. They need enormous amounts of compute to do it. Google Cloud is supposed to be one of the premier providers of that compute. And yet, Google told Meta, no. Several other Google Cloud clients have also reportedly been affected, though to a lesser extent. This is not an isolated incident. It is a systemic capacity problem across one of the world's largest cloud providers. Google CEO Sundar Pichai acknowledged earlier this year that capacity constraints were limiting Google Cloud's revenue growth, and that the cloud backlog nearly doubled quarter over quarter. He said this as good news. But the Meta story shows the other side of that coin. When demand doubles and supply cannot keep up, customers get rationed. Investor context: who wins, who loses? Let's talk about your portfolio directly. Alphabet, Google's parent company, is the most exposed name here. Google Cloud grew to $20 billion in quarterly revenue in Q1 2026. That is impressive growth. But this story reveals that cloud revenue could have been even higher if Google had more capacity to sell. Every dollar of unmet demand is a dollar of revenue that went somewhere else, or nowhere at all. Alphabet's next earnings call in late July will be closely watched for any comments on capacity expansion and whether the bottleneck has been resolved. Nvidia is the quiet winner in this story. When Google cannot build fast enough to meet demand, the urgency to buy more Nvidia GPUs and accelerators increases. Every hyperscaler that hits a capacity ceiling accelerates their hardware procurement. This story is indirect confirmation that Nvidia's order book remains strong, even during a week when Nvidia's stock fell sharply. CoreWeave and independent cloud infrastructure providers also benefit. When the hyperscalers cannot meet demand, enterprise customers look elsewhere. CoreWeave, which specializes in high-density GPU compute, is a direct alternative for companies like Meta when Google says no. Meta itself has the most interesting long-term reaction. The company has been building its own AI infrastructure aggressively: custom chips, private data centers, and its own open-source models through Llama. Being rationed by a competitor is exactly the kind of experience that accelerates that internal build-out. What the market is missing here is the angle most analysts are not discussing. This story confirms something that should concern every investor holding hyperscaler stocks at current valuations. The AI infrastructure build-out is not going according to plan. Microsoft, Google, Amazon, and Meta have collectively announced over $300 billion in AI capital expenditure for 2026. The market has priced these stocks as if that spending translates directly into revenue. But Google rationing Meta is proof that building at this scale is harder than the Capex announcements suggest. There is a lag between spending money on infrastructure and actually having it operational. Data centers take 18 to 24 months to build. Chips have supply constraints. Power permits take years. The demand is arriving faster than the supply can be built. This creates a window, potentially 12 to 18 months, where AI demand significantly outstrips available compute supply. For investors, that window is actually bullish for infrastructure companies and bearish for the narrative that hyperscalers have unlimited capacity to sell. The market is currently treating the capacity crunch as a temporary embarrassment. Smart investors should be treating it as a structural condition that will define the next 2 years of AI investing. What happens next? Here is your concrete roadmap for the next 60 to 90 days. Watch Alphabet's earnings in late July. Analysts will press directly on Google Cloud capacity, the Meta situation, and whether Google has concrete timelines for resolving the constraint. Any downward revision to cloud growth guidance will hit the stock immediately. Watch Meta's earnings in late July as well. Mark Zuckerberg will almost certainly be asked about AI infrastructure dependencies and the Gemini rationing situation. Listen for whether Meta signals accelerated internal infrastructure investment and what that means for their Capex guidance and margin profile. Watch Nvidia's order flow commentary. If Google is capacity constrained and accelerating procurement, it shows up in Nvidia's data center revenue guidance. The August earnings call from Nvidia becomes even more important as a read on whether the infrastructure demand wave is continuing or cooling. Watch CoreWeave and independent cloud providers for any enterprise customer announcements. Meta shopping for alternative compute providers after being rationed by Google is exactly the kind of contract win that moves smaller infrastructure stocks significantly. For positioning, this story reinforces the infrastructure theme over the model theme. The companies building the pipes, Nvidia, Broadcom, CoreWeave, and power infrastructure have more durable near-term demand than companies whose valuations depend on model revenue. Alphabet is the stock to watch most carefully heading into earnings. The AI capacity crunch is real. Smart investors position ahead of the earnings season that will confirm it. And that is exactly what we do here on AI assets every single day. If you want to stay ahead of the AI investment curve before mainstream media catches up, subscribe to AI Assets right now and hit the notification bell. We drop fresh analysis every single day. No noise, just signal. Drop your thoughts in the comments. Do you think Google's capacity problem is a temporary growing pain or a serious structural risk to Alphabet's cloud valuation? I want to hear your take. See you in the next one.